Welcome to the Fast Five by Fear and Greed. I'm Michael Thompson, and good morning, Sean Aylmer.
Good morning, Michael.
Sean, today we're actually going to try and cram a whole lot into just 5 minutes. We're going to tackle all the big economic questions. Will interest rates keep rising? How long can unemployment stay so low? A few others, as much as you can jam in, basically.
And in under 5 minutes. There's only one person for that job, economist Stephen Koukoulas, of course. You can find him on Twitter at @thekook. Stephen, are we going to see interest rates continue to rise this year?
Globally, we will. But domestically, the jury's out that maybe the RBA has done enough because the economy is starting to slow down. It looks like inflation's going to be topping out through the course of 2023. The global economy is heading for a hard landing. So in a sense, there's this debate, do we really need to see the RBA continue to hike? Or if you like, can we ride on the coattails of a global recession, dare I say it, that will put inflation pressures down, and the RBA can sort of sit back and allow Australia to keep growing, albeit at a slower pace, and benefit from the disinflation that's happening in the global economy.
Okay, so maybe the Reserve Bank does that. Maybe it lifts rates one or two more times early in the year, but there's actually a chance that late in the year, rates might fall.
That's exactly right. And look, the market is still pricing in the possibility or probability of, as you said, one or two more rate hikes in the early part of this year. But later in 2023 and certainly into 2024, they're looking at, as I said, rate cuts. They're looking at the slowdown in the economy being so severe that inflation will be back within the target range. And dare I say it, after these possible rate hikes early in the new year, that we're going to be talking about rate cuts. We're not quite there yet. Certainly it's the case in the US, where the Fed's been a lot more aggressive than the RBA with its rate hiking, and the hard landing in the US economy is seeing the futures market there pricing in rate cuts later this year. But here, the jury's out. It's going to be a difficult balancing act for the RBA, whether to hike now and cut later or just keep a steady hand through 2023.
Okay, you mentioned inflation tailing off somewhat. We've really experienced a rough 12 months, be that petrol prices, food prices. What do you think will happen in 2023 with inflation? All
of the leading indicators are pointing to low inflation. You look at the commodity price indexes, you look at petrol prices themselves, as you mentioned, food prices, lumber prices, the timber which goes into housing construction. They're all down. They're all down on the peak that was recorded in the middle of last year, 2022. We've seen demand for commodities taper off. Things like copper prices are down. Aluminium prices and these sorts of things which go into the production process are all tilting lower. And to me, that's a leading indicator in the inflation forecasting regime. And so the question is really, how quickly will inflation decelerate? Not will it decelerate? It will. It's just a matter of the speed at which we go from what will probably be an 8% inflation reading for the December quarter, when we get those numbers shortly, down to 7 to 6 to 5, and then hopefully back to the 2 to 3 target for the RBA.
Okay, can we keep the unemployment rate at 3.4%, which is a 48-year low?
No, we can't, and that's a pity, because low unemployment's a sort of an economist's dream. 3.4% unemployment's great news, but it's probably too much of a good thing. It's a bit like that last glass of red wine I had on Christmas Day. I probably didn't need it. I can't have it. It wasn't sustainable. But we do need, with the economy slowing, it's almost certain that the unemployment rate's going to tick up. The Reserve Bank, Treasury, and I think the private sector consensus are all forecasting higher unemployment through the course of this year. The question is, can it be contained, going from this roughly 3.5% to 4%, or will it get a little bit above that? If it starts getting towards 4.5%, we know that the economy's slowed down by more than enough, and that's when we get to that earlier point that a 4.5% unemployment rate probably would demand that the RBA not only stop its hiking cycle, but might start to consider rate cuts.
Righto. Got 3 very quick questions. We've got no time left. Wages. Will people be getting pay rises this year?
Yes, wages are picking up. The tight labour market is feeding into both public sector wages, where there's a bit of a catch-up due for them, and private sector wages are still very strong. They'll continue to increase.
House prices?
Well, we're nearly at the low point for the house price cycle. High immigration, the end of the rate hiking cycle, a really tight rental market say to me that the bottoming out in house prices is coming soon. Won't be a strong rebound, but prices will bottom out very, very soon.
And economic growth, will we go into recession?
recession unlikely. Business investment will be the sort of foundation of economic growth, and that's pretty much baked into the cake. Business investment being strong will prevent a recession. We householders will feel like there's one. Spending will be cut pretty dramatically as we have to find more money for our mortgage obligations, but no recession.
Thank you, Stephen, for talking to us on Fear and Greed.
Thank you, Sean.
That was economist Stephen Koukoulas. Find him at thekouk.com, thekouk.com. Good news on house prices, Michael.
Sean, I can't believe that we just covered interest rates, inflation, unemployment, wages, house prices, economic growth, recession risk, and wine on Christmas Day all in 5 minutes.
Pretty good.
That is not bad. There we go. That's it for today. Make sure you hit follow on the podcast. There's a new episode every day. Regular business news back as well from January 16. I'm Michael Thompson, and that was the Fast Five by Fear and Greed.